Everybody, I want to continue my series on gold investing and talk about all the different choices of ways to invest in gold. So let's jump right in. Let's first talk about physical gold, the obvious one. Physical gold is obviously the most direct way to invest in gold. You can buy it directly from government mints, private mints, special metal dealers, and jewelers. They're all going to have various different pricing and costs involved in buying it. From a maintenance standpoint, you need to store the gold in a secure place, like a safe. You need to insure it. It can be expensive, and that's one of the things that I caution people. Look, you want to own a few coins, no big deal. Hide them in your house. But if you're going to have a significant chunk of money in gold, you start worrying about it just sitting around in the house. I know people that have buried it in their yards. I know people that have hollowed out a wall and filled it. I know a lot of variations of that, but if you're going to pay to store it, then you typically are paying to insure it as well. So you'll have those ongoing fees. Liquidity, it's generally pretty easy to sell gold. The question is what the price difference is. So there is a buy price and a sell price, and they are not the same. So it's the same as exchanging currencies out there. You want to switch your US dollars to euro, there's a buy price and a sell price, and that's how the dealers are going to make their profits typically. Returns, you can look at the history of gold. The returns are obviously in the basis of the price of gold, plus or minus the fees to buy and sell. So when you are investing directly in the physical gold, you have to factor in the cost to store it, the cost to insure it, and that spread price that we're worrying about. The U.S. gold eagles are considered currency, so therefore there's no capital gains upon buying and selling, but technically all other forms of gold, you will owe the taxation on the gains of it. Then there's gold funds, the pluses and minuses of buying gold funds and a gold ETF. The by far most popular one out there, the ticker is GLD, and the ease of buying and selling and not needing to insure. That is why these are so popular. So obviously, any stock market exchange, any brokerage account, you can buy a gold ETF. The maintenance is little to none, let's be honest. The fund takes care of all that for you and sends you your tax forms at the end of the year. So they say that they can be tax efficient. It's far and few between. Don't take that. That's more of a sales gimmick than anything else. Liquidity, again, one of the big reasons that gold ETFs are so popular. You have got the ability to buy and sell just like a stock. Returns based on the value of gold, but I say based on it. So you don't really physically own the gold, you own shares of the fund. So understand that this is a gold portfolio minus the fees, anywhere from 0.1 to 0.4% in fees. All right, mining stocks. Let's briefly talk about those. There's a lot of words on this one, but I want to make sure everybody understands when you're investing in mining stocks, that's significantly different than diversifying with gold. One of the cons that you will see on here is you're going to have a better correlation with actual stocks on there. And I like equating it to the gold miners in the gold rush days weren't the ones making the money. It was the ones selling them the pickaxes. So you have some significant risks that are added when you buy mining stocks. So why do people do it? Well, you look, it does have the potential for higher returns, although in recent history it has not proved that. it has the potential for dividends, and the dividends are there trying to attract the investors. Liquidity is good, but as compared to what GLD, maybe not, but ease of investment and liquidity are going to be the same as maybe a gold ETF. Very liquid, very easy to invest in. GDX is the biggest by far ETF that owns the gold mining stocks. The reasons that there's a stigma and people tend to stay away from gold mining stocks: higher risk and volatility than gold in general, operational risk, right? These companies, and especially the smaller companies, you don't know who's running these things and how well they're run. Underperformance during gold rallies, because again, you have the risk of the company themselves, and correlation with broader market, which we don't like. So you look at the chart here, and gold has significantly outperformed the mining stocks by far in this last couple of decades here. So in general, a difficult proposition. It's not the same as owning gold. Leasing and lending, this is more of a newer arena. This was only in the central bank world. So countries' central banks used to lease out and lend their gold, and they moved away from that, and now private companies, private marketplaces are popping up doing the gold lending and leasing, and it is becoming, I guess I would say, obnoxiously popular for very valid reasons. So that's the important part, and I'll do some other videos on what lending and leasing is. But just imagine being a gold mining company and having, a whole bunch of gold in the ground. You know what it's worth. You know how much is in there. But what if the gold price goes down? The profitability of the mine falls apart if you borrowed your money in US dollars, which is the way it has happened mostly in the past. But now you can borrow in the form of gold, in the metal that you're mining. That becomes very important for anybody that utilizes gold in their manufacturing process, which, by the way, is a lot more than you would think. Pretty much every electronic has gold in it. So understand that there's a lot of uses of gold out there, and there's a lot of entities, companies out there that want to borrow in gold to take away the price fluctuations in what they are borrowing. So you can lease and lend out physical gold. And the nice thing about this is that you're essentially just earning interest in ounces of gold. So the way you can do this, well, it's only through a private fund or private marketplace. Okay. And the problem with the private marketplace, as you will see, is you're the one that then has the responsibility of vetting the individual leasing companies and borrowing bond companies. Borrowing is the bond side. So the private fund, well, they do that for you, versus the private marketplace is an open world, and you can invest in what you want there. Both cases, you have to be an accredited investor, which I've done videos on what an accredited investor is as well. The fund manages the portfolio of leases and bonds, okay, from a maintenance standpoint. So it's like owning an ETF or a mutual fund, right? They do all the worry about the accounting and taxation and all that. It is a registered fund, but it is still a private investment. And then there is the marketplace, and if you choose to do that, then you have to vet and manage that through the marketplace yourself. And they only accept non-qualified money, whereas the fund accepts qualified, meaning Roth and IRA money as well. Liquidity, it's always going to be based on the terms of the lease, the bond, the fund, whatever it is that you're investing in. Typical leases are 1 year. Typical bonds, you'll see anywhere from 3 to 5 years. Typically, you'll do longer terms on the bonds. And the difference is very simple. The bond, you're actually lending your gold, whereas the lease, lease, you still own and maintain that gold. The lease has the lower risk and is typically insured throughout, so pretty safe. And most of the leases out there, you're looking at about 4% right now. So returns, well, you own the gold. Even in a gold bond, they have to pay back the ounces of gold, not the dollar amount of gold. So when you're lending and leasing it out, you actually own the ounces. And that's the important part. Think of this more as a currency. So you have to be paid back those ounces of gold. So if the price fluctuates, you still gain the win or loss, the ups and downs of the actual physical gold price. But on top of that, you're putting it to work for you. You're actually earning. So you can earn anywhere. I've seen leases down to 3% on up to the bonds I've seen all the way up to 13%. And you're earning interest in ounces of gold. So you're kind of compounding it because of that. Pretty fantastic. Fees, well, the fund does have a 1.5% fee, but you're instantly diversified and instantly earning. Net of fees, you're still seeing over 4% out there. And the marketplace has the spread on purchasing the gold, but you're getting the industrial buying of gold. It's way better than going to the local gold shop. Way, way significantly better. So obviously, if we're comparing owning gold versus owning gold and earning, owning gold and earning is always going to win out. So if we have an average of a 4% return, so that's on the lower risk scale. Again, the fund has mixed in bonds and things like that, so their yield is significantly better than 4%. Even net of fees, we're doing that, so shouldn't be a problem at all. So gold versus gold plus 4% over time makes a significant difference. So gold from 1971 to 2024, that's right, almost 8% annual rate of return. That's pretty fantastic. So you look at a $100,000 investment and you end up with over $400,000. So, and that's just, the actual returns from 2006 to 2004. So that's not going all the way back to 1971 because GLD didn't really exist back then. And the point of this chart is GLD is gold, but it has the attrition of the fee. And again, it's by far the largest, most owned ETF that owns gold. So you're going to follow the price of gold, but you're going to lose to the attrition of fees. And that's just the GLD fee. If your advisor is taking out a fee as well, you're losing there as well. Then you got GDX, we've already seen, has in modern history in the last couple of decades has definitely underperformed, has not done well. And then you have gold leasing, gold plus 4%, and that wins, obviously. If you are an accredited investor, you got to have over $1 million net worth, or the big or, I think it's 300,000 worth of income annually. So as long as you've got an investable net worth over $1 million, you have access to the far superior way to invest in gold. And from a diversification standpoint, when I start recommending gold for a portfolio from an investing circumstance, well, it typically is some of the larger portfolios. You get these 5, 6, 7 on up, the hundreds of $1 million portfolios. You start getting over 5 million for the average retiree, and that's usually going to be a larger portfolio. The weird thing is I don't have a dollar amount for a larger portfolio. Everybody over this should. No. A lot of this has to do with your budget. Do you have a big part of your net worth that you're not going to need for yourself, or you're not going to need it for another 20, 30 years? It's too hard to predict the future 30 years out, especially the investing future. So having a hedge not only for your portfolio, this is a great diversifier of your portfolio, but it also helps diversify from a currency standpoint in case over the next 20, 30, 40 years, we see a devaluation of our currency, see bigger inflation, things like that. This gold will help in all those scenarios. And that's why, when we're looking out further, when we have chunks of money that we're not going to need for quite a while, this is a great way to build that wealth and diversify your portfolio. All right, I hope that helps. That's lots of different ways. There's some quick, easy ways to implement into your portfolio on top of, for the bigger, larger investors, some far superior ways to invest in gold. Happy to have any discussions with you. If I can help in any way, yourinvestmentcounselor.com. You can schedule a free meet and greet with myself or Grayson, the fund manager for that matter. Full classes, fpfeaz.org. That is the nonprofit. Jump in there and register for those classes. We do a different topic every month, and there's 4 or 5 different days of the month that you can jump in and join those classes. Give us a call, smash that like button, and I will see you next week. Thanks again.